good afternoon, and might be in some regions, good morning as well. So thank you very much for joining the session. And today's session is about sustainability reporting, a very hot topic. And this is what we will be discussing the current developments in the context of the history as well that I'll discuss today with you and the future directions. Myself, Ahmed Farhan. I'm a fellow member, chartered accountant and partner at Crest Cooper. Our today's agenda is as I just gave you a hint, that we'll be discussing background of the integrated reporting. What is in fact integrated reporting? Very important and interesting to know that I'll highlight on it. Then overview of the sustainability reporting, and then I'll discuss a bit about the core concepts of sustainability reporting. Well, the background. In fact, the thing is that we, the accountants, know that financial accounting is all about the items which we can measure in monetary terms. But the need was felt somewhere in the early 90s that the financial and non-financial, both information which are important for the primary users or the decision makers of the financial statements, should be reported. So keeping in the importance of the reporting, it was looked into that certain non-financial information should also be the part of our reports. So when the financial and non-financial both are reported together, that report is known as integrated reporting. So the integrated reporting framework was introduced, in which basically the principle which was addressed, that was to focus on the strategy side. Means to provide insight into the entity's strategy and how it creates value. Means when we just simply present our financials in the report, which is about the financial position, financial performance, the cash flows, it does not in fact 100% reflect the strategy and the value creation by certain stakeholders for obviously the shareholders, for the employees, for the customers, for the suppliers. So they all are hungry for the value that is created for them. And ultimately, the value is created for the entity. So this needs a passing on of information through the reporting. So that was focused in the integrated reporting. And then connectivity of the information means the financial and non-financial information both should connect together, so that the financial information is supported by the non-financial information, and the non-financial information is supported by the financial information, so that the decision maker can take a better decision, which is ultimately creating value for the entity. And the stakeholders' responsiveness, that I just told you, that there are certainly certain stakeholders who respond to the information provided to them through the reports. Materiality is focused over there. Conciseness, to the point, not to confuse the reader with so many details. So should be very much to the point and reliable and complete. So this was in fact the core principle of integrated reporting framework. So what happens that, as I told you, in the early 1994, there was a report which was released in South Africa, which emphasized on the integration of corporate governance in the financial report. So this was the first report, which was known as King 1. So the King first report in 1994, which was focusing in fact on the corporate governance, it was like based on the concept of directors' responsibilities. Obviously, the decisions are mainly made by the board, which is in the hands of the directors. So what they are focusing on, what is their strategy, what the steps they would be taking in the future, and how they are moving forward, how they are like focusing on the financial resources and even the non-financial resources for the entity, and how they are making arrangement for the financial needs for the entity. So that how, with so many other things for which the directors are held responsible, is to be reported. This was King 1 report in 1994. Then moving forward in 2002, this research was expanded on the corporate governance and introduced the concept of integrated sustainability reporting. So the strategy along with the sustainability was then reported with the financial information. Then in 9, the emphasis was made on the importance of the sustainability and integrated reporting, and introduced the concept of apply or explain for the corporate governance. And ultimately in 16, King 4 report that is focusing on the corporate governance, sustainability, integrated reporting, and special emphasis on the importance of the organizational culture, leadership, technology, just to achieve the good governance. So this is what like the King report was released. So now the people, means the corporate world, they start feeling the importance of the non-financial reporting to be integrated with the financial reporting thing. So what happens that by the time there are few sustainability reporting frameworks were released, which include very popular GRI, which was launched in 1997 with the this CERES is Coalition for Responsible Economies and the Thales Institute. So in this collaboration, the first GRI guideline was released in 2000, yet 40 GRI guidelines have been issued. And just a brief intro that this GRI guidelines are divided into 3 categories. One is like, you can say universal standards, sector specific standards, and topic standards. So by the way, like in a way, they are in fact addressing the need of sustainability at different level. What the sustainability is, in fact, sustainability is let the entity maintain its existence of profitability and beneficial for the stakeholders onwards, and let the external and internal factors do not prevent the entity to grow. This is sustainability. So this sustainability not only includes the financial, even the non-financial effects, which is like ESG, environmental, social, and governance. So it was like addressed by GRI standards. Then Sustainability Accounting Standard Board was formed in 2011. It is like American-based board, and it has also released, in fact, industry-specific standards. Okay. And almost, I guess, 77 standards have been released by ISSB. for different industries, for different sectors, that each sector should know the sustainability level, how that is achieved, and what are impacting negatively on that entity's sustainability. So SASB was in 2011, it was founded. And then there is a task force on climate-related financial disclosures, TCFD. It was established in 2015. Then Dow Jones Sustainability Index in 1999. And then the game changer, in fact, the main game changer, which is ESRS, European Sustainability Reporting Standards. These European Sustainability Reporting Standards, they have released almost, I guess, 11 standards yet. I have put a slide on it. Excuse me, I guess there is some issue with the screen sharing. If the admin can give me the screen sharing rights. Admin is available there and listening me?
Yeah, let me sort it out quickly.
Well, I trust everyone can see the screen now, and I'm audible, clear, and loud. All right. So what I was saying, that the need of sustainability reporting arose, and different reporting frameworks were then introduced, and ESRS is in fact the game-changing framework which released its standards, draft standard. I believe it is 11, and I'll be showing those to you in the upcoming slides. And its research work is ongoing. And very interestingly, um, uh, most of the things which ESRS has researched and released, ISSB is also on the same lines. So ISSB is in fact the board which was formed in 2021 by IFAC, which is releasing now IFRS on sustainabilities. So this is the whole background that precisely I put in front of you. Yeah, 12 draft standards by ESRS. Okay. So these are the standards which the ESRS has released on general requirements, general disclosure. Then E1 till E5 are about climate, pollution, water, biodiversity, resource use, etc. Okay. And S1 till S4 are about the sustainability, which is on force, works in value chain, like that. So now the important thing that comes in our mind, in the minds of the accountants, that what to be followed. Should we follow ISSB or ESRS? Basically, ESRS is like the European standards, and they are obviously following the standards. And they are this much rigid on these standards that the exports from your country to the Europe would not be possible unless your standard, your industry or your organization is meeting all those standards. So meanwhile, when ISSB released IFRS S1, S2, the compatibility was established there. And like you can interoperability is there. Okay, you can operate, you can have either of the ESRS standards you can apply, or ISSB. So I just give you the main features or the difference that we can see in the ISSB and ESRS standards. So these are the two, in fact, prominent frameworks which are providing guidelines for the sustainability reporting. And there are so many similarities. But the key difference in these two is about the materiality approach, which is very important to understand. Look, by the way, ISSB is focusing on financial materiality, whereas ESRS is focusing on double materiality. So what is this double materiality concept? It's very interesting. Supposedly, your organization is like having impact of the external factors, and at the same time, your organization is impacting the external world. Let me make it easy to understand. Supposedly, you are having a restaurant. I have given an example of restaurant in my upcoming slides. So that restaurant is exposed to certain risks from the external factors, from its environment, from the social, okay? Means external factors are impacting the sustainability of that restaurant. At the same time, this restaurant is polluting the environment. So this ESRS focuses on double materiality, means the material impacts from the external to the entity and the material impacts from the entity to the external world are both like considered, okay, which is like the financial materiality that the entity is having impact, and the impact materiality which assesses an entity's impact on the sustainability matters. You understood? Whereas the ISSB is like focusing on the financial materiality, only what the entity is having impact on its performance, profitability, okay, financial resources. Okay. So the financial health, then the scope and the stakeholders are like different in terms of like comparing with ISSB with ESRS. The primary focus of ISSB is on the primary users. If you can recall the ISB framework by the International Accounting Standard Board, which I call it like the mother of all IFRS. It is in fact the bedrock for all the IFRS. It identifies three stakeholders as the primary users of the financial information. And all these stakeholders, these three stakeholders, investor is the provider of the finance, the owner, the shareholder. Creditor is the provider of the raw material or goods or services on credit. Again, facilitating the entity in terms of finance. And lender is again the provider of the finance to the entity, which is for a time bond for some time period, 3 years, 10 years, like that. Okay. So all these three are the financer for the entity, and these are the primary stakeholders. ISSB is focusing on the needs of those primary users of the financial information. Whereas ESRS aims to satisfy the needs of broader group of stakeholders all together, even covers the local community as well. So here you can realize the concept of double materiality, two-way traffic is there. So climate-related disclosures, IFRS S2 is about climate-related disclosures, and ESRS E1 is about climate-related disclosures. Okay, both are almost similar, but E1, which is ESRS E1, requires more detailed information, which includes the scenario analysis, etc. And then sector specific, yes, here ISSB is like industry specific, whereas ESRS, they are expected to release sector specific standards in 2026. So this is what like we can say is happening in our today's current situation, and what we are foreseeing in the future in this like sustainability sector. And interoperability is there, obviously, that both are, if any of the entity either follows ISSB or ESRS, it is considered that it has fulfilled the requirements of sustainability reporting. So it is interoperability. Wonderful. Let me give you now a very simple example to understand the sustainability accounting or sustainability reporting. In fact, the thing is that I have put an example of a restaurant over here. What it is exposed to sustainability risks. By the way, remember one statement that you should carry while studying the sustainability related standards. That is risks and opportunities. IFRS S1 and IFRS S2 talks about the risks and opportunities. Sustainability related risks and opportunities, and climate related risks and opportunities. This is what uh, we have to disclose in the integrated reports. Okay, so risks and opportunities. So this slide is about the restaurant which is exposed to several sustainability risks. And I'll take you to the next slide at once so that you get orientation that what we will be discussing in these two slides. The restaurant is open to several sustainability opportunities. So these are the two very important areas to understand what we are supposed to report, the risks and opportunities. So taking an example of a restaurant, why I took that example of restaurant, because we all are very much familiar with the business of the restaurant. Okay. And it is easy to understand that in a restaurant, what we see that energy is consuming. And because of the consumption of energy, carbon emission is there. Remember, when we say carbon emission, it is like a combination of 7 gases, carbon dioxide, methane, like this, okay, which are like potent in different levels. Carbon is the most like least potent, and others are more potent than comparing with the carbon. So what we have set a criteria that we base our like greenhouse gas at the parameter equivalent to the carbon. And then what the gases my organization is emitting are then worked out equivalent to 1 carbon. So there is a mathematics there, which is calculated. Suppose my organization, my entity is releasing methane is almost, I guess, 680 times. So we will be then like working out the equivalent to 1 carbon or carbon. The carbon footprints are in fact known as greenhouse gas emission. So these terminologies are very important to understand. At the same stage, let me tell you one more point, because mostly the financial reporting like responsibles, we get confused in certain terminologies. There is scope 1, scope 2, and scope 3 greenhouse gas emissions level, which is in fact detailed in IFRS S2. Scope 1 is what the restaurant is directly emitting because of the process into it. Like a restaurant is into the process of cooking food. So while cooking food, there are certain greenhouse gases which that restaurant is like emitting. Second is like what the suppliers have like supplied to the restaurant, supposedly electricity is supplied by the electricity supply company to the restaurant. And because of that supply, the restaurant is emitting certain gases. So that is scope 2. And then scope 3 is the gases that are like emitted by the third parties to whom that entity is stealing. Like again, uh, the organization in itself from which the entity is getting supplies, that is emitting gases. The third party's emission of gases is scope 3 gas emission, you can say. So these scope 1, scope 2, scope 3 gas emissions are like taken over there. So by the way, like what I was saying, so restaurant is exposed to several sustainability risks. Number one is energy consumption, which is like carbon emission. So inefficient systems and outdated equipments can produce more, can emit more carbon footprints. Okay. So this is the risk which is associated to that entity. Then water usage, waste management, regulatory compliance, and climate change. So all these are the risks which are means associated with that restaurant business, which the restaurant is exposed to. At the same time, that restaurant is open to several sustainability opportunities as well. What are those? Like if that restaurant uses solar panel for electricity, so what it would be doing, then it would be in a way having a carbon credit with itself. Means the carbon credit is something which mitigates the carbon footprints or greenhouse gas emissions. Okay, so means it is in fact into a system which is known as renewable energy. Okay, so renewable energy, energy efficiency, water conservation, building certification, employee engagement in like promoting sustainability initiatives, okay, and technological innovation, which is reducing the this carbon emissions. All these are the opportunities which the entity is open to. So now the thing is that the entity which is exposed to certain risks and open to certain opportunities, what is the net position of that entity, which is known as net zero. Okay. So the entity which is emitting carbon footprints and at the same time is into certain activities which are providing opportunities for the carbon credits, if carbon credits are equal to the carbon footprints or carbon emissions, then it is at the stage which is net zero. So it is something that very simply I'm like trying to communicate to you. Okay. So that areas are the opportunities for an entity. Now I'll take you through the core concept of sustainability related financial disclosures, which is like in S1. By the way, S2 is about climate related uh, this sustainability disclosures, climate related risks and opportunities to be disclosed. This is discussed in IFRS S2, and then IFRS S2 also talks about certain industry level requirements for the disclosures. So S1, in fact, the basic objective of S1, as I told you, to disclose the information about sustainability, which is related to its risks and opportunities. Okay, which is useful for the primary users. I have defined the primary users: investors, lenders, and the creditors. And what the primary users in fact do, they take decision to provide resources, financial resources to the entity. So this is what the importance of this disclosure is, that when the primary users, they will get to know about the risks and opportunities associated to that entity related to the sustainability, then they can take better decision to provide finance to that entity. Okay, supposedly again, if there is an entity which is like emitting carbon footprints, okay, and there's no mechanism over there of like carbon credits, so there's no opportunity related to the sustainability over there. Ultimately, what happens? It starts polluting the environment. It is disturbing the society at large and governance as well. So, what very first impact would be over there? They will lose their goodwill. People will not be having their reliance on the output of that entity. And they would certainly be exposed to the fines from the regulators. And as I told you, they would not be able to export their product, because now you would see that certain like countries, they have put this as a criteria that you should be at net zero as to your sustainability. So if you're not at net zero, it means you have lost your credibility over there. Okay, let me tell you one more thing, very interesting over here. There are so many like slides to come, like, but we have very limited time of this webinar. Uh, about the carbon credits. As I told you, that carbon emission is something that you are emitting, your entity is emitting. Carbon credit is something that you have an opportunity through renewable energy, or by managing your waste, or by managing your water usage, or even like by growing plants in the like area of your organization. Like if that's big and you have a plot of land which is free, you can grow plant over there. It is like uh, uh, again an opportunity for the entity which is giving carbon credits. So what happens? Supposedly, if there is an entity which is not like able to uh, make renewable energy, okay, or cannot like put some plants in the entity in the premises, is there any solution for that entity to get net zero position? Yes, there is a solution. This is very interesting thing that I'm just sharing with you, which is not the part of this presentation, but for the sake of your interest and knowledge, that carbon credit is nowadays considered as a commodity, as a product. And there are carbon exchanges which are existing in the world. And by the way, one carbon credit today is priced at $6.97, almost $7, you can say. And in the upcoming years, people are like having an estimation that it will rise to $200. Okay. So, by the way, this is what I'm saying, that yes, you can buy carbon credits. So, buying carbon credit means to seek permission to emit carbon footprints. You understand what I'm saying? Seeking permission from whom? From those agencies or the markets or the dealers who are authorized and are selling carbon credits. So how they are selling carbon credits? Because they are producing carbon credits in a way. I'm just talking in a very layman language. They are producing carbon credits. How they are producing carbon credit? They have grown mangroves in their premises, in their plot of land. They are into renewable energy. They have like installed plants for renewable energy. Okay. So like these are the organizations which are producing carbon credits. So what happens? There are certain agencies, they register these organizations which are producing carbon credits. Then there are certain auditors who audit the carbon credits, the number of carbon credits they have like produced. And then there are exchanges at which these carbon credits can be sold. And your entity, which is unfortunately is emitting carbon footprints only, has an opportunity to buy those carbon credits from the exchange. At the point? Through this, your entity would be able to like mitigate your carbon emissions or carbon footprints with the carbon credits, and ultimately your product would be acceptable in the international market. So this is the whole story, in fact. So by the way, like in the IFRS S1, we talk about the sustainability related risks and opportunities. And in IFRS S2, we talk about climate related risks and opportunities that needs to be disclosed. Okay. So what are these in fact? These risks and opportunities are expected to affect the entity's prospects over the short term, medium term, or long term period. Short term, you can define your own short term like a quarter. Medium term, you can say 12 months period. Long term, you can say 3 years or 5 years time period. So what you are in fact focusing on this entity's prospects about the entity's cash flow, its financial position, okay, means uh, access to the finance and the cost of capital. So this is what you will see, that how our risks and opportunities are impacting the financial prospects of the entity. The core concept, if I talk about this IFRS S1 and IFRS S2, that is about the governance, that who is governing your entity, strategy, who is giving strategy, and what are your strategy in the short term time horizon, in the medium time horizon, in the longer term time horizon, and how your entity is managing the risks of sustainability. We are talking about the sustainability risks, okay? And it also comes the opportunities and the integration of these risks and opportunities with the financial figures. And the metrics and the targets that are developed in all this like risks and opportunity game. Quickly, I'll take you through some of the important areas, then I leave you for the question answer session. This is an example that there is for the governance, okay, for the governance model. There is a board at the top, okay, and this board is having a committee, which is a risk committee. And when we talk about risk, there are so many risks that the entity is exposed to. Among those, one is the sustainability risk. Okay. So the board ensures that the risks within the group are appropriately identified, reported, assessed. So means all the risk management is like under this domain through executive committees or through group risk committee, okay? And finally, if you understand the concept of line of defense, The first line of defense is there, second line of defense is there, and then the third line of defense is the internal auditors. First line of defense is like the process owners who are supposed to perform their duty as per the SOP, is simple as saying, as per the controls established. Second line of defense is the stringent controls which are there to be followed. And the third line of defense is the internal audit, which ultimately reports the miss or like the inappropriate activities over there, which are in fact preventing the entity to work without any risk, means which are creating risk for the entity and creating failure for the entity in certain areas. So internal auditors, they also report the like board, audit committee, ultimately the board is there. In the same way, there's a sustainability advisory committee. Okay. So these are in fact the committees through which the board manages the risk or governs the organization on the whole. Okay. Then we will talk about the strategy, and strategy is like you can say that what are the risks and opportunities for the entity and what is the time horizon for which the entity will be disclosing its strategy. Okay. And what are the effects of those risks and opportunities on the entity's value chain, business model, and financial position, performance, cash flows, strategies. Okay. Because like when as I just shared with you, like if you are not having carbon credits level of opportunity within your entity, then you will be buying carbon credits. Okay. When you would be buying carbon credits, it means that you are having something in your mind that in the short term or medium term or longer term time horizon, this much cash outflow is required just to manage your sustainability. So this is what like you would be disclosing, that what is the strategy of the entity. And you have to define and disclose the time horizons, short term, and I just take you through quickly. As mentioned here, short term, medium term, long term, you will define your strategy and you will link with your organization's planning and strategy thing. And this is how, like in the current reporting period, you would be identifying risks and opportunities, describing and their impact on the cash flows, performance, profitability, and their financial position, balance sheet items, etc. Their significance will be, and how they are taken from past events or in the current condition, and what will be their impact, how they would be impacting in the future. Same you will take for short term, medium term, and long term. Okay. So this is how like you would be defining your strategy and putting it at the time horizon, that how the entity would be strategizing its sustainability and what would be its impact on the financial performance and the cash flows. Look, this is the example of disclosure. Like, for example, just read over here. Sustainability trends underpin our opportunity for long-term sustainable, profitable growth. And today our products are mitigating the climate challenge. Okay. Mitigating means net zero. Okay. And providing us with new opportunities. What new opportunities? That you are in surplus and you can sell your credits in the exchange, you know? So this is what you can strategize for your, because it's a big opportunity that start producing renewable energy and start controlling your waste, start managing your water usage, okay? And energy efficient products or the appliances should be used, so that you not only mitigate or come at the net zero, you start producing carbon credits, which you can then ultimately sell in the market. This is a big opportunity for the, I would say, organizations, not only for the organizations, but for the investors. This is the tomorrow, you can say, in the sustainability ambit. Okay. So our strategy is to drive the green transition by accelerating our growth in renewable packaging, okay, and sustainable building solutions and biomaterials innovations while staying with the plenty boundaries, etc. Blah blah blah. So this is how the organizations they. Okay, then comes risk management. As I told you, that it is something that you have to manage your risk, and you have to prioritize your opportunities. Like, just read this point: the processes and related policies and the entities used to identify, assess, and prioritize the sustainability related risks. And in the same way, the process, they have to disclose, okay? Disclose the process that the entity used to identify, assess, and prioritize the sustainability related opportunities. So this is what your entity has to disclose. And the extent to which and how the processes for identifying, assessing, prioritizing, and monitoring the sustainability-related risks and opportunities are integrated into and inform the entity's overall risk management process. Okay. Entity risk management, ERM. So in that risk management, your fight with the sustainability related risks and opportunities also considered. Or in a way, your strategy and your management for risks in overall scenario is important. Now, the last point that I'll be discussing, and will definitely, inshallah, manage to conclude in time, metrics and targets. How do we work thing through metrics and the targets? There's an analysis. Supposedly, there's an activity. The entity name is Green Tech, and it has sustainability targets for 2025. The entity's sustainability report provides the following data: that greenhouse gas emission, which is carbon dioxide, CO2 emission in tons, is 10,000 tons. And its target is to reduce it to 7,000 tons. Its water consumption, by the way, all these are the risks, okay? Its water consumption in million liters is 5,000. And its target is to reduce its water consumption to 4,000. Okay. Remember, when I told you about the sustainability, in fact, the sustainability that I told you, that to maintain its life of the entity without depleting the natural resources, remember, and without polluting the environment, and without disturbing the society. So this is what the ESG, the impact of the sustainability on the ESG, okay, and the reciprocal impact of ESG on the entity's sustainability. So water consumption, like you are currently consuming 5,000 million liter, that you are aiming to reduce to 4,000. Your waste reduction, like you, as of now, you are reducing like till 2,000 tons. Now you are aiming to reduce 2,500 tons. Okay, so you will be like in a better position then. Employee training hours, as of now, you are giving 1,000 hours for the employee training over the sustainability ESG impacts, that you will raise till 1,500. and supply chain span with certified sustainable suppliers. You are dealing with sustainable certified suppliers. That is like 30% that you would be increasing to 50% of your suppliers should be holding certified, so that scope 3 level of GHG emission is also managed. Okay. So this is the data, and based on it, the question, because it's an activity that just I'll be sharing with you, and you can like work it out yourself. Calculate the percentage reduction in GHG emission required to meet 2025 target. So what was that? We are aiming to reduce it to 7,000 beans. We will be reducing 3,000 tons of the carbon emission times 10,000. It means 30% would be the percentage reduction. So these metrics need to be disclosed in our integrated reports. Okay. Then, as the percentage increase in waste reduction, we have aimed it to like increase the reduction of waste to be increased with 500. That is 25% more. We will be in a position to reduce the waste. Then in the same way, like it's a simple mathematics that you can like work out. So this is how like we produce the metrics and targets. And as to IFRS S1, just define the targets. This table will help you in understanding what IFRS S1 requires us. Definition of the target, okay, and then metric used to set target, sources of metric. That metric is like based on the ISSB or law or regulators or other sources, because like this is very important to disclose what we are. As I told you, interoperability is there among the ISSB and the ESRS, European standards. So this is what like you have to define that what is the source of this metric that we are using, like waste management or electricity efficiency or renewable, like that. Okay, so this is how like you would be disclosing your targets and milestone 1, milestone 2. Okay, wonderful. And finally, you need to give a statement of compliance. Okay, so that statement of compliance, that an entity whose sustainability related financial disclosures comply with all the requirements of the ISSB standard shall make an explicit and unreserved statement of compliance. That could be exempted, okay, if law or regulation prohibits disclosure of information required by ISSB, if that information about the sustainability reporting opportunity is commercially sensitive. Okay. So by the way, like if there is a prevention for its disclosure, then you can like stop disclosing. Otherwise, as to the requirement of ISSB framework, it is important to disclose. Okay, thank you so very much. God bless you all. And I really appreciate your attendance. And my disclaimer on this is that I certainly use certain like reports and information from the certain websites. Okay. And that is part of my presentation. This presentation is not, you can say, a professional advice. It is just like a presentation which was prepared to generally give you an understanding of the sustainability related financial reporting. And thank you so very much. This is Chris Cooper, and we are holding our offices in USA, UK, UAE, and New Zealand. And I trust that your entities would be putting their reliance on Crest Cooper for the services that we are giving. By the way, we are also into sustainability consultancy. So thank you so very much. God bless you all. If you have any questions, please feel free to discuss. I'm available.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.